decrease the volatility of a portfolio by doing that.
That's right. You decrease the volatility, and what we can also use is we can use the capital markets. We buy this portfolio. It has some real estate, it has some REITs in it, it has some direct investment in property, and we can buy some bonds. We can hold cash, which brings it down this way. Okay? Now, what we do is we go out and invest directly. You either manage your own portfolios or you have people that advise you, right? We have views on that, but you have people who advise you on the structuring and the management of risk.
You know, all this you bring is very interesting, but historically, in my mind, I cannot go before 1930s Depression time. But what we have now is a zero interest rate environment, and it's going to change sometime. Has anybody used that in all these equations? How would that play out?
Well, in fact, they have. There's a lot of controversy on how that's going to play out, and there's lots of journal articles, and people have lots of opinions. But right now we have a very low interest rate for lots of interesting reasons, and what that but this line, in fact, this line may not even be straight, and I think that's the point you're getting at, because of capital rationing and a bunch of other weird things that are still going on in the capital markets right now.
This week in Japan.
Yeah, that's a good example. And so, or else the line is straight, and these different assets are on and off the market. And the problem is, it's all fuzzy. It's like shooting through a cloud at a target. And so we never really know. In fact, this frontier is a fuzzy frontier. But this I think provides us kind of a general framework. Next. Okay, now let's talk about tactical. If strategic asset allocation is kind of the trunk of the tree, the tactics, some of the things we do, are kind of the things that you hang from the tree, right? And tactical asset allocation is active management of the portfolio. And it's designed to exploit pricing anomalies in the market and other kinds of things. What it allows the portfolio manager to do is to create extra value by taking advantage of certain opportunities, unexploited opportunities that the manager may see in the market. Now, it may be a will-o'-the-wisp, it may be true. But a good example of that is what we do right now. We'll go out into the market and we'll find properties that are in the hands of weak owners. And if we can provide capital immediacy, we can buy these assets at a relatively low price, particularly with regard to replacement. And there are all kinds of tools. Now, you don't have to relegate these tools just to building portfolios. Next, what we do is we use these strategies every time we look at deals. And one of the things we observe in the market is that there's a lot of mythology about real estate, and we try to be very discerning. Our view is that if it's too good to be true, it's likely not true. If you cannot understand the investment, run the other way. And this reminded me of something that I saw. I actually collect investment strategies that don't make sense and tactical ideas. and I was trying to think, well, what is the image that would best represent that? And so I came up with this. It's called unicorn meat. And just because it's out there doesn't mean it's true. Nature does not like perpetual motion machines, and markets do not like free lunches. And as I said, the only free lunch you're going to get is diversification. Next. Now, a good example of a tactical approach is timing. And this shows the NCREIF Property Index, the annual rate of return for all the institutional properties in the United States. I like this one for a couple reasons. One, it shows the crash here, 2007, and this is the lowest the index has gone since it was started in '78. Encore was founded here, right? And the market was still moving along pretty well. But what I found interesting and what brought me to Encore was this. Encore was a net seller in 2007. And there are very, very few firms that did that. Let me go to the next one. Okay, now, we're going to wrap this up, and I'm going to share with you some interesting stuff. Really interesting. What I like to do is I like to look through old real estate magazines. And what I do is I take quotes out. And I figure, well, if I can find quotes from the best and the brightest in the industry, that may tell me something. I may learn something. So this quote is from a fella who is the managing partner of one of the largest private real estate equity firms in the world. My wife said I should not put his name there. He said, January of 2008, it's a great time for folks who have been sitting on the sidelines waiting for the markets to come their way. Commercial real estate prices can correct, but they're not going to crash. Now, let me tell you something, and maybe it's by luck, but Matt and I put together a paper and we gave it to the Urban Land Institute, and there's about 2,000 people in the audience. And we talked about the coming crash, and we characterized it as a Darwinian herd thinning event. Darwinian herd thinning event. And it had such an impact. I was the first speaker of the day. It was characterized by the next panel as if I had backed up a liquid nitrogen truck and sprayed the whole audience. And the rest of the day were people trying to offset this presentation, which we did in late 2006. I look back at it and I thought it was a pretty good presentation. What we missed is trying to figure out the exact timing and also the channels through which it would occur. But this was certainly the received wisdom back then. Also in 2008, the debt markets provide rich opportunities. As one manager said, anyone with a wallet can make money now. Capital flows during 2008 will remain strong. This person is the president of the leading pension real estate consulting firm in the world. This person, March 2008, my Minsky moment was last fall when a friend and highly respected investor told me, in explaining his very aggressive bid and his 5-day due diligence on a $100 million plus deal. Due diligence is for sissies. Anyway, that's the environment. And what happened was when the market backed up in late 2007, we were trying to arrange equity for a $100 million portfolio. This is very quick. I'm talking to the traders on the street, and usually I'd get something back in about 5 minutes, 10 minutes, and a day goes by, 2 days, and I asked him, he said, well, we're having trouble figuring out where the mark should be. And I said, oh, by the way, just out of curiosity, on the debt we're trying to place, what if we wanted to go recourse on it? This is just an idle comment, we've never done that. He said, oh, it'd be the same spread. I turned to Matt and I said, Matt, this is like going to Prudential, getting a life insurance policy and having to pay 0 premium. And at that point, this was August 2007, I said, it's over. It's going to be a problem. Next. So I don't know if you can see this very well. You have to turn off the lights. Can you turn off the lights? At least here. Okay. This, you can't see it too well, but this is Virgil leading Dante through one of the circles of hell. And this is fire and brimstone. Dante's Inferno, the evil counselors. I thought that was fitting. Lessons from the crash. What is very clear when you look at what people were talking about, that crash fell way outside of people's experience and frame of reference. And as a result, people were raising record amounts of money in 2008 because they thought the market had hit a new floor. And they thought they were now in the basement. What they then failed to realize was that there were 10 basements under that. Next, the causes of the crash were multiple in number and interdependent. And the commercial real estate industry did not foresee the recession or the crash in 2007 and 2008. And investor styles did not change much from 2007 to 2008. Most investors lost their balance. So when the search firm came and told me about Encore, I said, that truly is an unnatural act. Let me show you how unnatural it is next. Okay, this is the economy as a train wreck. And for those of you that's the Gare du Nord, great railroad station. Only a few firms sold assets and held cash. And this chart shows bank failures, right? And if you take it back, early in the 20th century, it never raised, except for the Depression, it never even reached that level. But this shows failures, and this is Encore as a net seller. And this shows transactions volume. What happens in a crash is that particularly with banks can't trust the other banks because we don't know what the value of their assets are. And so what happens is banks don't stop lending to other banks. Liquidity dries up, and when liquidity dries up, transaction volume falls. And that's exactly what happened in 2008. And when transaction volume falls, what does that do? that means that price discovery fails. And when price discovery fails, it feeds back and volume declines even further. Encore was a net seller in 2007. Next. Now this is particularly interesting. There's an index called the VIX. It's a volatility index and it's based on the S&P 500. And it's widely used as an index of market uncertainty. It's called the fear index, appropriately. This is where Lehman files for bankruptcy on September 15th, 2008. This is Encore selling its assets. Now I like this one. Excessive leverage. I feel safe up here. Let's go higher. I like this. Building castles with excessive leverage. What happened in 2008, the spreads opened up. This is the spread on AAAs, but look what happened to triple Bs. That's the lowest investment grade credit rating. Look at that. And Encore is a net seller. Lending volume collapsed, spread opened up, and what happened is many owners eager to deleverage were forced to sell their best and most liquid assets. And it created a cascading effect. Next. And if you look at cap rates, real estate people like to think in terms of cap rates, but price is sort of the inverse, roughly the inverse of that. When prices peaked around here, cap rates were at the lowest. In 2007, Encore is mostly out of the market, and then prices fall or cap rates rise. And you can see this for the different property types. What's interesting is that apartments didn't experience anywhere near the price compression that the other asset classes did. Next. And this shows the returns, quarterly returns on the NCREIF index as it falls. And this shows money coming into the market. Remember earlier I said 2008? There was a record number of funds that were raised, and this shows the surge in funds. And most of those funds never got invested. Next. And then finally, with the backdrop of the crash, where are the opportunities today? And I want to give you just with 2 slides, just a snippet. First, today the market is still volatile and it's changing. And that's good for us because we do value-added and opportunistic kinds of investments. It's a great opportunity. Capital is in some sectors scarce. It's hard to believe that, but it's true. So if you find some owners that have bad balance sheets or they want to, maybe they have office and retail and they want to get rid of their office, or they just need capital, it's a great opportunity. Risk management has never been more essential than it is today. Identifying risk and pricing it. Now, what tends to happen with markets is they tend over time to revert to the mean. And what we're now starting to see is the market reverting to the mean. But we think there's like a 2 to 3 year window for a lot of these opportunities. And our view is that what you want to do, even if you're not managing a fund, what you want to do is you always want to have these long-term targets and views about risk. And you want to be constantly examining them and testing it and looking at the market from a standpoint of different kinds of scenarios. And what I'm going to show you is exactly an example of what we do. Next. This shows rental growth for the US and for Dallas. And this is a forecast for Dallas. And Dallas is in red. This is for office. And this is the US. And what's interesting about Dallas is that, it doesn't have the supply side constraints that some cities do, but it has a remarkable growth engine. And this econometric model anticipates over the next 4 years significant expected rental growth in offices. Next.